Per usual, living on the channel is for educational purposes only and is not intended as financial advice. It is Macro Monday time. Let's take a look at some legacy charts. Throw me a like, dislike, or comment. That helps the algo. And if you'd like to do so, you can join the channel with the join button below, or the Discord as well. I'll put that in the description of the video. Starting with the usual James Butterfill flows report, and now he's got this in bold up here. But I got to be honest, until the grayscale stuff is out of our system, the flows are not as valuable. Not because they're going down, but just we know they're going down, right? There's a lot of churn happening in general. So it'll be interesting to see where this normalizes, right? Because clearly, we have a punctuated equilibrium of sorts, right? We have a market event, new products come online, we have products dumping billions on us. It's going to take some time for things to sort themselves out. Clearly, Fidelity and IBIT leading here. The rest of the ecosystem seeing small inflows, but not much. And pretty much outflows across the board from everybody. And based on where price was last week and where it went, should be no surprise, right? We kind of went straight down throughout the week, recovered towards the end of the week. The big headlines regarding products from this past week are a potential Schwab Bitcoin ETF. Schwab is bigger than Fidelity. They may come in and release a product around 10 basis points or something. More products, the better. We also had a Hong Kong Bitcoin ETF application. I believe this is what this is. So again, we're not seeing less products. We're not seeing less interest. We're seeing a lot of people who don't have Bitcoin in their portfolio gain access to Bitcoin over time here. So I don't see that as bearish. As far as the chart is concerned, as a recap real quick, we tapped 4,300 already today, and we're kind of in this massive decision tree, pluripotent stem cell phase, okay? A lot of things could happen. This could turn into cancer. I don't know, right? It depends what the market feeds it. It depends what market signals, hormones, enzymes, all that sorts of the soup that feeds into making your liver cell a liver cell, right? That's kind of where we're at right now. This could still shape out in a lot of different ways as we're getting carved around by legacy this week. This could still morph into some sort of inverted head and shoulders. It potentially has already satisfied a right shoulder. Ultimately, if it's above the 8-hour cloud, that's probably good enough. If it's above 43.3, that's probably good enough. Good enough for a long trade for me. So definitely watching that. This could also qualify as an Adam left, which would be in the Adam and Eve double bottom pattern. This could be a broader left shoulder of an inverted head and shoulders. So look, we got time, right? This is potentially what an Adam and Eve would look like, take us through February. The problem with an Adam and Eve up here is that we'd be once again dipping into the daily cloud. Now, I was super bearish on the daily cloud entry. Upon looking into my own system, once again, we didn't have a bearish TK cross. When I did some backtesting on the edge-to-edge trades on Bitcoin on the daily, I found that the best, highest probability trade setups were those that had a congruent TK cross. So it kind of makes sense that we didn't continue. We weren't bearish enough yet. I think we are likely to see a bearish TK cross upcoming. So again, we are still very much in the pluripotent stem cell phase because people are going to get very bullish above 43, and this doesn't have to cross. But again, this is a decision tree. This is not a time for me where I'm excited to take a trade in any direction. I'm just kind of waiting. In any event, Adam and Eve would not really make much sense from a cloud perspective. So that may end up morphing, again, we're pluripotent, okay? We could be a bunch of things here. It sounds like I'm the guy scribbling on the conspiracy board. Just things to watch for into Q2, into halving. This would probably make more sense as a possibility because then it would satisfy a cloud edge to edge. It would make sense if the cloud resets, you get a bearish TK cross. Now, if we just blast through 43, then that's invalidated. Adam and Eve is invalidated. It just doesn't matter. So it kind of depends on how we react here to 43. And back to that edge to edge idea real quick. If we dial it back to the daily cloud in 2021, mid-year, an eerily similar situation where we quickly dipped into the cloud, did not have a bearish TK cross, pulled up a little bit, kind of held at that 43K level equivalent, got the bearish TK cross. This whole area was a massive mess because even I was thinking at the time, because I had sold somewhere in the high 50s. I think it was around the bearish TK cross here. But even I was thinking, like, did I screw this up? So I think pre-halving, doing nothing is fine. But the bottom line is, look, we could still see this bearish edge-to-edge move on the daily if we get a bearish TK cross, which we almost certainly will. So it's something to watch out for still. So I wouldn't get super comfortable just yet, because again, we could be a lot of things here, right? We could turn into an epithelial cell, or we could be cancer, we could be a muscle cell. Just depends on how this week goes, depends on how the rest of February goes, honestly. So we have lots of time to decide what we want to be when we grow up. As far as legacy is concerned, the big thing this week, there's a lot of little stuff. There's Mag 7 earnings, but the big thing is FOMC on Wednesday, as well as the QRA quarterly refunding announcement on Wednesday. Truflation, which is a measure real time of inflation, continues to crush lows, continues to sit at lows. This does not have a lagging housing component, which is one of the reasons why CPI remains as high as it does. It has a 6-month moving average on the housing data. And the next question here is, how low do we go on truflation? A lot of people still calling for Bianco, a few others, right? Calling for high 3s on inflation. We're just not seeing it yet. So that's perfectly possible. Let's say the Fed cuts and inflation returns, the markets just go to infinity and everybody's spending again, I guess. But the data is not showing that at the moment. It's not even showing directionally higher highs here. And if Powell's looking for sort of multi-month 2% weakness in CPI or PCE or core blah, 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 he's going to get it if he stays up here, because again, that housing data is slowly working its way through the ecosystem. The next CPI print for January coming in by the Fed's own estimation at 2.96. If we look at the last CPI print, that's down significantly from 3.4. That's, I believe, the first two-handle we've seen on inflation since this all started. So we are certainly closer to the Fed's target than farther away from the Fed's target, but it just, again, depends on what they want to measure. If they want to look at core PCE on a 3 to 6 month basis, as Callie says here, we are there. We are there. That's the Fed's target. Okay. And I know there's people who think we don't need to cut. There's people who think it's going to be political. I hear you. I understand all of that. But how tight does the Fed want to be? How tight do they want to remain? That's the question that hopefully they answer on Wednesday. Now, they don't want to wait till the election cycle to start cutting. Okay. So they're going to have to start cutting sooner rather than later, unless they want to be seen as political, which I don't think they do. So we are very much there as far as core PCE is concerned. And this is from Nikki Leaks at Wall Street Journal, the Fed whisperer, potentially hinting at what the Fed might come out with this week and say, there's a risk that we're being too restrictive with real rates. Again, depends on Wednesday. We'll see what he says. We'll see what Powell says. There's some more evidence in CPI versus PCE. PCE has a basket that contains the housing component a little less than CPI. And again, depending on what you want to look at, it says we are certainly getting there. We are on our way from a variety of different measures, and we are going to see that housing component work its way through the ecosystem on the CPI side of things. If we look at the housing data, right now, as a renter, I love this. Send rent, send year-over-year rent just completely lower. Last year, I fought off a rent increase. We'll see what happens this year. But this certainly does not look like a extremely inflationary housing environment at the moment, based on that data. So if we look at the probabilities for the CME, again, they're not going to cut this meeting. It's all about next meeting. Basically a coin flip. I think that's fair. The further down the year we get, the more likely we are to see cuts, not because of weakness, not because of recession, but because we are too restrictive on real rates or too restrictive relative to inflation. Now, Powell has said in the past, higher for longer, I'd rather be too restrictive and fix it later, right? Okay, that's fine. But again, it depends on what he says Wednesday. So definitely listen for any specifics around that. Now, if he comes out and says nothing, I don't think the market's going to be too happy about that. If he says we're going to wait till next meeting to make a decision, it's not hawkish, but it's not what the market's looking for. Definitely not. From CQ at CNBC, if we look at the average time between a hike and a cut, again, we're there. So you know, it's like I'm talking to a specific group of people that think like this is political, this is a conspiracy, all the data is fake. I'm not going to disagree. Look, it is what it is. But if you look at the data historically, this is about the time when the Fed starts to cut. And I think if anything, if you're worried about a recession, if we're cutting ahead of that, you know, maybe that's a good thing. There's been other discussions about how do markets react to cuts. This is from Ryan. You know, I love his, I'm not going to call it cherry picked data, but it's very specific type of data, right? So he looks at he's looking at the first cuts here in the S&P. On average, we're higher if it's a normalization cut, as he says here, not because we're seeing a recession, not because there's some sort of panic going on. So the normalization cut has led to higher markets 3, 6, 12 months down the line. Not a lot of data, obviously, but data is the data. And something else many people are saying, including myself, like, do they need to cut with markets at all-time highs? Ryan again looked at that, and the Fed has cut plenty of times with markets, S&P at all-time highs. So this isn't like crazy that they're doing this here. And markets have gone higher a year later, 20 out of 20 times. We just had a GDP print that was at 3.3%, thanks to a lot of government spending. The next estimated GDP print is somewhere around 3% based on the Atlanta Fed. Got a long ways out till the Q1 print, but so far, so good. You know, I think that's as far as you can take it with that data. Looking at the yield spreads, this is the 10-2, still inverted. The uninversion is what kills you. The uninversion is where you typically see unemployment in the yellow here creep up. And, you know, again, we're not seeing it on the entirety of the United States. Yes, you will see pockets of layoffs. We may even see on a state-by-state basis rising unemployment. But as a group, as a country, we have not yet seen that in the data. And if you want to be granular about it, 38% of 50 states have triggered the SOM rule, which is a recessionary warning signal. The SOM rule is when the 3-month moving average rises by 0.5 percentage points or more. And if we look at historically where we're at as a country on the SOM rule, not yet triggering that. And the reason this is important to pay attention to, that's sort of the point of no return. That's the point at which we've typically seen both a recession and just sort of runaway unemployment. And we are not seeing that yet. So even though things may look or feel recessionary to you as an individual, we just aren't seeing it in the data yet. Okay, that doesn't mean it's not going to happen or it can't happen. It's just we're not seeing it. Back to yield spreads for a second. I started tracking this a couple weeks ago, just sort of curious what the matrix looks like. And we're not quite even close to uninverting on most of this stuff here. The big uninversion to watch for is actually the 10-year and the 3-month, and that is still deeply negative. So we've got some time here. Now, I do think all this is going to come to a head eventually with BTFP ending mid-March, reverse repo running out probably before Q2, depending on what the QRA looks like in the mix of bills and bonds. You know, that may drain this even quicker. So I think we'll know by Q2 how recessionary we really are. And that may lead to some panic cuts. It may not. The Fed typically doesn't like to be hyperactive in an election year, but they have been, just because that's when the problems sort of crop up. And so we will begin to understand that into Q2, right? If we have rising unemployment, if we have yield spreads uninverting, GDP print curling down, you know, inflation curling up, if we have all that sort of mix of maybe stagflationary stuff, like things could get bad, right? But right now, I don't think anything's bad enough to prevent me from getting out of the market or anything like that, right? We still have plenty of the reverse repo to drain. If we look at just the difference between 2022 and 2023, where the reverse repo basically bottomed out, this white line, this is the inverse reverse repo. And, you know, look, the liquidity injections have been excellent for markets, and we still have a ways to go on the reverse repo. And why that's important is because it's feeding the debt. The insane amount of debt that we are issuing, we are feeding the coal into the fire because we have this stockpile, this slush fund to drain. But that's going to change once that's emptied. And then we'll see what the market's really made of once that liquidity spigot is turned off. As we move into charts here, again from Ryan, looking at, you know, January's bullish. How bullish is the rest of the year? So goes January, goes the year, as he says. So look, we had a bullish January, we had a very bullish January, and it may be hard to tamp things down here for the rest of the year. Something else he looked at, he talked a lot about the Santa Claus rally leading up to it, during, and then not actually materializing. So he looked at that. And again, it's just funny, like the hyper specificity of this data. So he's looking at a negative Santa Claus rally with a positive January has led to N of 3. Okay, not a lot of data, but it's it's just funny how specific we get here with that data. Anyway, so that's been bullish as well. So it's really hard to find bearishness at the moment. I talked about the S&P and the Qs yesterday. They look phenomenal. We'll take a look at the Mag 7 today. This is IWM. This is the small business index, and it is starting to look better to me. If rates come down, this is very likely to break out above 200. This is very likely to move back to all-time highs. Small businesses, smaller businesses are the most rate sensitive, and so they would benefit the most from rates coming down. Technicals have you potentially above the weekly cloud in a 2-year consolidation pattern, and maybe there's even some sort of Wyckofffian accumulation here. But the cloud certainly loves this into mid-year, which would make sense if rates come down throughout the year. XLE is the energy sector ETF. This is one where we probably don't want to see highs get made in energy, because that would mean inflation probably is creeping back up. But just another one to watch throughout the year. This looks like it may have saved itself on the ascending triangle, and it's sort of getting to the point where you'd expect a breakout pretty soon here. So again, mid-year, we might see, for I don't know why, as far as the rationale, but we may see energy creep back up. Hopefully not for geopolitical reasons, but technicals for this also lean bullish so long as the current low holds on that. SMH is the semiconductor ETF, much like the Mag 7, has just sort of taken off, cup and handled out, and that's been all she wrote. This certainly looks a little overextended, as does the majority of Mag 7, but I don't think you can necessarily bet against this. It's just, I don't know how much more is left in the tank up here. It's getting pretty close to targets where I would be taking some off the table in personal positions. Now, if we look at the Mag 7 as a group, they are bigger than every country's stock market except the United States, which is pretty wild. So they are their own country at this point. Apple, to me, had leaned pretty bearish. It survived the breakdown below the cloud. It survived a retest of the 200, and it has made its own little cup and handle here over the past 6 months, and certainly looks like it wants more. It does have a bearish TK cross on the daily, so that's something to watch for, maybe as an entry signal down the road. It certainly does not look weak here, despite several not so great headlines that have cropped up over the past couple weeks for Apple. Microsoft looks, in a word, pretty insane, because it's just been on an absolute tear. It had a massive move in Q3, consolidated, and just took off into the stratosphere. Again, we are approaching levels where taking profit makes sense between 430 and 500. Now, we're not super close to those levels, but it's something I'm watching, definitely. But this chart looks phenomenal in the moment. NVIDIA hitting the yearly pivot, just absolutely skyrocketing, 620 thereabouts. This chart also looks, parabolic, kind of insane, but strong, very strong. You can't short any of this stuff, because that's how you get taken out in a body bag. When you're shorting stuff at all-time highs in price discovery, that usually doesn't work out for you. Google here also, I believe, at all-time highs. Cup and handle looks incredible. Looks like there's tons of room here left for Alphabet. They have earnings this week. Meta scarily in a parabolic advance here. And all of this may crescendo into some sort of blow off top. So it's okay to be fearful. I wouldn't short this. I know people are, but I just think that is a fool's errand. If we zoom in on the 4-hour, this looks like a crypto chart. This looks ready to land on the moon any day now, potentially this week with earnings. If this thing breaks up to 450 and then breaks down back to 400, that may be the end in the near term. So that's something to watch for. How does price react to earnings relative to this crazy parabolic move that it's had since mid last year. Amazon to me still looks strong as well. Plenty of room for upside here on this inverted head and shoulders above the daily cloud, and definitely looks ready to test all-time highs and then some, along with the rest of the group. Netflix, another chart that's just kind of insane that, this is not a crypto chart. This is a company just straight up on that earnings print and has held those highs. I'm not a buyer up here, but it definitely doesn't look weak. It definitely looks like thus far it's wanting more. It's wanting to hold on to those highs. For something like this, I think you'd want to see some consolidation up here. This thing looks like a bronchiosaurus or something with a long neck, just crazy move. Then there's Tesla, which looks like nothing else in the rest of the group. To me, this should continue to break down. Maybe it bounces a little bit, but it is very weak relative to the rest of the market. And if you think crypto's a cult, search Twitter for some Tesla analysis. That is a cult, okay? That is the embodiment of a cult. Various different accounts, you will notice them almost immediately, who are just turbo bullish Tesla. The chart just doesn't pan out that way at the moment. Once you're back above the daily cloud, back above the 200-day moving average, sure. But down here, down is the path of least resistance. Definitely doesn't look pretty with a triple top or whatever you want to call this. And there's this mega diamond potentially where, again, there's just very little likelihood of continuation in the bullish direction in the moment. And there's just so many other things to trade. Here's Tesla versus the QQQ. I mean, it's just been straight down in the opposite direction for Tesla since the beginning of the year. Kind of wild. To finish it out, here's a few of the other charts I'm watching. Square, back to that rule of the edge-to-edge trade. Square had an edge-to-edge trigger based on closing inside of the cloud. It did not have a bullish TK cross on its side. It's setting up for that. It's setting up for both a re-entry in the cloud and a bullish TK cross. So I still think this is a great chart to trade. It's a great setup to trade. Definitely something to continue watching. It's crypto adjacent. They tend to do better after Bitcoin halving. Rates are down, liquidity's up. So I still like this very much as a chart. PayPal had kind of a bogus nothing burger announcement. Price went up and down. It's still kind of like XLE, where if this is really going to break up, it's got to do that probably by mid-year, just based on chart pattern triangle rules that typically break 3/4 complete. You also have a potential for an edge-to-edge move in here from, let's say, 62 to 115 or something like that. So a 2x. Semi-crypto adjacent, they have that PayPal stablecoin. So probably something else worth adding to the watch list. Disney is another one. I know people have certain feelings about Disney. It's not necessarily for me, but as a chart, it does have a tradable edge-to-edge move here coming off of a falling wedge. So from a TA perspective, that looks pretty good. And now we're dumpster diving. Okay, this is Zoom. Many people will roll their eyes at this point. This is a dead company. I'm not going to disagree. There's better products. I'm not going to disagree. As a chart, it is something to add to the watch list because on the weekly, they're setting up for an edge-to-edge move. This may take you into 2025. I don't know, but it's worth just taking a look at or having an alert at, let's say, 72 or something. Just watching every once in a while. Rates should be helpful. Maybe they get acquired. I doubt it. I don't know, right? I'm just trying to think of things, why this would actually go up. But this is the type of chart where things happen. When it's been down only for 3 years, kind of hit a bottom, rock bottom, if you will. IPO listing, things may happen on charts that look like this. Is this a better trade than Bitcoin? I don't know, probably not. But again, it's something to watch. Definitely something to watch. Lastly, Snap, another one that is in the weekly cloud, kind of approaching its historic resistance level. Doesn't look half bad. Certainly has some edge-to-edge left in it. And if rates come down, all these companies are going to do well, most likely. So look, the recessionary crowd, I hear you, I see you, I believe you, but the data just isn't in yet, right? So what are you going to do between now and when the recession actually hits? Are you going to sit out everything? You could. That's an option. You just have to have a level at which you're wrong or continue to wait. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.